Budget 3.0 is heading to Parliament. That's as Cabinet's given the submission the green light. The approval follows intense negotiations between the members of the Government of National Unity. Finance Minister Enoch Godongwana will table the budget for the next 3 years next Wednesday. Cabinet's approved the publication of the Mineral Resources Development Bill for public comment. Governments not aware of calls by the U.S. to halt G20 work with SA. That's according to Minister in the Presidency, Khumbudzo Ntshavheni. The comments related to a report by the Washington Post, which says U.S. agencies have been banned from all work on the G20 in South Africa. This news comes just days before President Ramaphosa is set to arrive in Washington. His 4-day working visit aims to reset the strategic partnership between Pretoria and Washington, which has been characterized by friction since Trump was inaugurated in January. Trade conditions have come under a bit of pressure. The South African Chamber of Commerce and Industry survey for April shows that 49% of respondents reported positive trade activities. That's 6% less than the previous month. Saki says the VAT saga during the period did cause some discomfort, along with additional costs to trade. And yet the outlook appears promising. That's as 69% of participants expect conditions to improve over the next 6 months, with expectations for volumes, orders, supplies, and inventories looking favorable. Mining productions continued its downward trend. Output declined by 2.8% in March. This marks the third straight monthly decline in production, albeit at a softer pace than February's near 10% drop. The largest contributors to this performance were lower PGM and gold production. For the quarter as a whole, productions are down 4.5%. Analysts have previously warned that mining remains constrained by domestic bottlenecks and global headwinds that are likely to affect first quarter GDP. The Public Investment Corporation has appointed former Development Bank of Southern Africa boss Patrick Dlamini as its next CEO. This puts him at the helm of the largest investor in SA's equities markets. He will replace outgoing CEO Abel Sithole, who is set to retire in July. Equites Property Fund has reported an 8.9% rise in distributable earnings for the year to end February. A final dividend of just over 67 cents per share has been declared. That together, the interim dividend takes the total distributions for the year to 133 cents. That's 2.1% higher than a year ago. The distribution is at the upper end of the group's previous guidance. Looking ahead, Equites expects its dividends to increase at an above-inflation rate in 2026. It's targeting growth in a range of between 5 and 7%. It says this will be supported by a strong tenant base, the completion of several large-scale developments, and the certainty of overheads. Afrimats had a tough year. The mid-tier mining and materials company has posted a near 88% plunge in headline earnings per share. It's pointed to an underperformance of South Africa's export rail lines, as well as a stronger rand and falling iron ore prices. Afrimats declared a final dividend of 15 cents. That takes the total dividend for the year to 25 cents, which is 87% lower than the prior period. Looking ahead, it says it's looking forward to leaving the 2025 financial year behind and is confident that it has established a strong foundation to achieve the more robust results in the years ahead. Cartrack owner Karoo has delivered a 26% jump in full-year operating profits. That's as it benefited from growth in subscribers and revenue. Commenting on the results, CEO Zach Callisto stated that the period was one of strong execution, impactful innovation, and significant progress. In 2026, Karoo has guided earnings per share of between 32.50 Rand and 35.50 Rand. It says this reflects a lower rate of growth as the group is planning an upfront investment in sales and marketing. Sanlam's posted a 22% rise in first quarter operational earnings and a 15% increase in new business volumes. This performance, according to the Financial Services Group, marks a strong start to the year, supported by a satisfactory showing from all lines of business. It's pointed to general insurance, investment management and credit and structuring in particular. Looking ahead, though, Group CEO Paul Hanratty has flagged concerns the serious and long-ranging impacts arising from the tariff policies, but says it's too early to provide any meaningful update to Sanlam's earnings, considering the uncertainties regarding the tariff disputes. Barloworld has warned of a profit hit. The industrial giant expects headline earnings per share for the half year to be as much as 22.7% lower. That's largely due to a continued decline at the group's Russian unit. That business is taking strain as a result of sanctions on the country. Barloworld will release its interim results on the 26th of May. PPC is eyeing a profit bump. The cement maker says annual headline earnings per share from continuing operations should double. That's thanks to improved cost controls and savings from operational efficiencies that have been implemented as part of the group's turnaround plan. The company is expected to open its books on the 9th of June.